Good afternoon. I wanted to welcome everybody to joining our webinar today on the power of a self-directed Roth IRA. During this next 45 minutes or so, we're going to explore a little bit the Roth IRA account a little bit more in depth and going into some of the tax benefits, how those types of accounts work, and some of the general emphasis and things behind the Roth IRA, why they came into being. For anyone who's participating in the class live today, if you have a question during the presentation, you may simply type that question into the chat box on your screen. I'll make sure that I get that answered for you during the presentation. If you are listening to the recorded version of this webinar, jot your question down, and at the end of the presentation today, I'll have my email address and my phone number for you can simply call me or email me with any questions that you have. My name is Scott Maurer. I'm the the Director of Business Development here for Advanta IRA. I've been with the company since early 2006. At that time, I was brought in. The real estate market was kind of in a much larger swing than what it is, than what it came to be a few years ago. But in 2006, if everybody remembers real estate, going kind of like gangbusters, and people looking for more and more sources to purchase and get involved in the real estate investment business. Our company certainly was expanding as more people found IRA accounts as an option they might have to make these particular investments. I have been with the company since that time. I've spent more of the last several years, though, doing the education and networking and marketing for our company, trying to get as many people as possible to know and learn about self-directed IRA accounts. Now, just a quick disclaimer on Advanta IRA and what we do and what we don't do. We do not provide investment advice. We also do not endorse any particular products. So we will talk today about different types of investments that you can make in your IRA account, but our job is not to pass on the appropriateness of that investment for a particular individual. Our job is simply one as a record keeper and administrator to make sure the proper processes and the right flow is followed in order to preserve the tax status of the IRA account, or especially as we talk today, preserving the tax status of a Roth IRA account. We also don't give any legal or tax advice. Now, we will talk about some legal issues today. We also will discuss especially some tax issues as it relates to a Roth IRA account. As far as whether or not you should make an investment from a tax or legal perspective, I would encourage you to talk with a lawyer, talk with a CPA or an accountant. If you need the names of someone in one of those fields, a professional in that field, we can certainly give that to you as well. So just a quick background on our company. Again, Advanta IRA, we are a self-directed IRA administrator. The only thing we do at Advanta is record keeping and administration of the accounts. We don't sell any products. We are not a broker-dealer, so we do not invest our clients' funds or help them necessarily invest into mutual funds and stocks and kind of more of the conventional type assets one thinks about when investing with retirement accounts. The only thing we do is to handle IRAs or other qualified money and help those individuals make those particular investments, and then do the record keeping and administration that's associated with that. Now, as we go through some case studies later on in the presentation today, our role as an administrator and what we do at Advanta will certainly become more apparent. Now, what is a self-directed IRA? For those on the call who are unfamiliar with what a self-directed IRA is, in general, it's just a type of an account, retirement account, that allows the IRA owner themselves to pick and choose what investments that they wish to make, and allows them a much larger pool of potential investments. Most custodians, banks, and brokerage firms limit their clients to holding mutual funds, stocks, CDs, things of that nature within their particular IRA account. But a self-directed IRA, and especially our firm here, since we don't sell anything, we also don't limit you to what you can do within an IRA account. There's only certain things you cannot invest in, certain people you cannot deal with within an IRA. We will talk about those a little bit later today. As far as the possible investments that we see in a self-directed IRA, many different types of real estate, whether it be a piece of vacant land, whether it be a long-term rental property, could be a short-term flip, an actual rehab project going on within the IRA account. All of those are permissible. We also see a couple clients who do invest in commercial property. We also see a number of paper assets. We'll give some examples of these later on people doing equity participation, doing some joint venturing and structuring that deal in the form of a mortgage loan or a mortgage note. We also have people do options, assignments, tax liens, Still kind of all tied to the real estate business and real estate investment business, but maybe not actually holding the physical property, but holding the paper that's associated with it. We see a fair number as well of LLCs and partnerships. Those are great multitude of reasons why individuals form LLCs or LLCs. Some of them may be to hold their real estate investments, forming an LLC to hold that particular investment. It could be a hedge fund, could be a private startup company forming as an LLC or LLP that someone is looking to use their IRA to invest through as well. Now, the types of accounts that can be self-directed, any type of IRA, your traditional IRA, the most common type of probably IRA that's out there, a tax-deferred IRA. We also offer SEP and simple IRAs. Those are employer-based accounts where if you own a small business or you are a sole proprietor. The SEP, the simple IRAs, and also the individual or solo 401k accounts allow you to simply contribute more money in a given year. Those accounts are all considered tax deferred in the sense that you make contributions to a traditional SEP or simple IRA. You get a deduction on your tax return for making that contribution. The money is going to grow tax deferred, so as you invest and reinvest throughout the course of your life within the IRA, you do not pay taxes at each step of the process, which allows you to compound your money more quickly. But with a traditional SEP, it's simple, and a 401k, you do pay taxes then in retirement when you pull the money out of your IRA accounts. The government will give you the benefits of deferring taxes, but eventually they do want those taxes paid. Now, the other big type of account that we see that can be self-directed is what we're going to focus on today, and certainly for the next 15 or 20 minutes as we talk about the intricacies of a Roth IRA. Now, a Roth IRA is a special type of an account because of its tax consequences that it has or perhaps doesn't have depending on how you look at it. With a Roth IRA, contributions are made into that account. You do not get a deduction for them when you make the initial contribution, so you forego that initial benefit of getting a tax write-off for the sake of the fact that the money is going to come out to you down the line completely tax-free. We're going to go through that here in just a moment. Let's take a step back, though, and look kind of where Roth IRAs came from. How did they come into being? What was the impetus for starting the Roth IRA? Now, starting back in 1974, Congress created the traditional IRA account as part of the ERISA Act, whereby individuals who were not covered under their employer's pension plans, at that time, a lot of people's retirement, a lot of individuals had a retirement plan through their employer in the form of a pension plan. A lot of people did not. And so the individuals who were not fortunate enough to work for a company offering a pension, the traditional IRA was created to allow them to save similarly for their own retirement account and get similar tax benefits to those individuals who did work for an employer offering a pension and were participating in that pension. Now, when traditional IRAs were created, the laws prohibited anybody covered by an employer plan, like a pension fund, to also contribute to an IRA. So at that time, traditional IRAs were only for individuals who did not have a pension. Well, several years went by. In 1981, Congress decided to open up IRA contributions to everyone, regardless of whether or not you were involved or enrolled in a plan through your employer. They were still wanting to encourage more and more people to contribute, because the more money that you can put in your own private retirement account is the less money that you might need or might require from the federal government later on down the line. So Congress does encourage and does want you to put this money into a retirement account so you have more money down the line for your own personal well-being. So in 1981, they allowed and they opened up to everyone, figuring the more people, regardless if you were in an employer plan or not, the more people saving for their own retirement is going to benefit all of us in the long run. Now, in 1986, they made a slight change to the rule that actually is still in place today. So individuals who were covered under their pension plan and also making a contribution to their IRA prior to 1986 were also getting that deduction for their contribution to the traditional IRA. Now, in 1986, they changed the rules a little bit and said, well, if you were covered by an employer's plan through where you work, if you make a contribution to a traditional IRA account, you may not be able to take that deduction. It was dependent upon how much you made, what your modified adjusted gross income was, and then also whether or not you were involved in an employer's plan. Again, that is still something that's in place today. If you work for a company and you're part of a 401k plan through that employer, you may not be able to get a deduction for your contributions to a traditional IRA. Now, what happened after 1986 is looking back at what individuals were doing, the behaviors. Congress found that individuals were still making contributions to traditional IRA accounts without getting the benefit of the deductions. They were still had people making those contributions anyway, and still putting the money in and not getting those deductions. So in 1997, of course, then you're putting kind of after-tax money. When you make a contribution without getting a deduction, that money is going in on an after-tax basis. Well, in 1997, a senator from Delaware, William Roth, proposed that individuals making those types of contributions, one in which you make a contribution and you do not get a deduction, money should be treated differently from a tax perspective. So the Roth IRAs were created for individuals who were still covered under an employer's plan to still contribute to an IRA. Because again, some people were still making contributions, other people weren't, based on whether or not they were getting a deduction. But by creating a Roth IRA, there was an incentive for individuals who were not getting deductions to still put that money into the account, make that contribution on an after-tax basis, because now with the new Roth IRA, all earnings within that account were going to grow tax-free. So prior to 1997, some people had hesitation about putting money into a traditional IRA without a deduction, because they weren't going to get any kind of further benefit down the line other than taking that small portion of the account back out without paying taxes. It can be a little bit complicated, but just stay with me. But in 1997, by allowing for the Roth IRA, individuals still made those contributions without deductions, and then were able, from that point on, to have that money grow tax-free and have there be no tax on the distributions from that account. That's why the Roth, that's what the seminar is called, The Power of the Roth IRA, and why any financial advisor or CPA also will tell you how incredibly important and how incredibly powerful these particular accounts are. The ability to make a contribution now into a Roth, pay the taxes on this small seed, and then have that seed grow into a tax-free plant, basically, for those who want maybe a more visual understanding of what's going on. So the ability to pay tax now and not worry about going forward what the taxes may be. So that's how the Roth IRA came into being in 1997. And just another note, kind of a historical, in 2006, through President Bush's tax cuts of 2001, the Roth 401k was also added. So if you're involved in a 401k, you may have the ability to also contribute a portion of your 401k as Roth as well. Now again, to contribute to a Roth IRA, though, you do have to have earned income. So you must have W-2, Schedule C type income to justify the contributions you make to a Roth IRA account. Now there is some limitation we'll cover in just a moment. If you have too much income, if you make too much money, you may not be able to contribute directly to a Roth IRA account. There is some limitations placed on individuals contributing to Roth depending on their adjusted gross income. But again, as I've mentioned, the Roth IRA, there's no taxation on the earnings, and you have no taxation on the withdrawals when you pull that money out in retirement account. So you had this money grow over a number of years. You reach retirement age after 59 and a half. You start pulling out of your Roth IRA, knowing that that money is something you can pull from without paying any taxes whatsoever. You can also continue to make contributions after 70 and a half. There's no mandatory withdrawals. Anyone who has a regular IRA or 401k that is 70 and a half or older is required to take a minimum amount out of the account every year. With a Roth IRA, because that money is already going to be tax-free, the government will allow you to not take the money out if you don't need it, and then leave that money to your heirs, to your beneficiaries, who will take tax-free distributions over the course of their lifetime as well. Now, if you can't contribute to a Roth because you are over the threshold with your adjusted gross income, it may be possible to still contribute to a traditional and do a conversion to a Roth IRA. I'll talk about a conversion, what conversions are, in just a moment. So again, why do people choose Roth IRAs? Again, they don't need a tax deduction. They might as well make the contribution to a Roth IRA, knowing that these all are going to be tax-free earnings later on down the line. There's no RMDs. It can be an estate planning tool. If you know you want to leave some money to your heirs without having any tax consequence, and having that money just accrue to them, be a way to maybe purchase or structure different transactions within your Roth IRA. And especially if you're anticipating that you're in a higher bracket in the future, and you contribute now to a Roth IRA, you ultimately pay less tax on that money by foregoing the deduction. You won't pay as much tax if you're going to be in a higher bracket, or there might be higher tax rates in the future as well. Now, as far as the differences between a traditional and a Roth, that's what this slide represents, is simply some of the differences between the two. Again, the traditional IRA gives you that tax deduction this year or the year that you make the contribution. It gives you tax-deferred growth, but the Roth IRA not only gives you that tax-deferred growth, it's actually going to be tax-free ultimately when you do reach retirement age. Now, when you take money out of a Roth IRA account, in order for that money to come out to you completely tax-free, you have to meet two requirements. One, you be over the age of 59 and a half, because if you distribute money from an IRA before 59 and a half, whether it's a Roth or a traditional, you are subject to a 10% early withdrawal penalty. But after 59 and a half, that 10% penalty goes away. The other requirement for Roth IRA is you've had a Roth, for at least 5 years. So whether you established a Roth IRA in 2014, and that was your very first year you had a Roth IRA, you're going to have to wait till at least 2019 and be over 59 and a half to get tax-free withdrawals from that account. Now, if you established a Roth IRA 10 years ago and you've subsequently moved the funds into, say, an Advanta account to make an investment, you're over 59 and a half. Your 5-year clock started when you opened up your very first Roth IRA. Now, there are some exceptions. If you were disabled, a first-time home buyer, you're paying for the qualified education expenses for yourself or a dependent, you may be able to take the money out prior to 59 and a half and not have a 10% penalty. Now, here's the phase-outs for 2015. If anyone's looking to make a contribution to a Roth IRA, I mentioned there can be restricted based on how much money you make in a given year. So if your modified adjusted gross income and your filing status with the IRS is single, if you make more than $131,000 of modified adjusted gross income in a given year, then you cannot contribute to a Roth IRA. If you make under 116, no problem, you can make the full contribution. Anything in between, you can make a reduced contribution. Now, if you're married filing jointly and combined, you and your spouse have a greater than $193,000 of modified adjusted gross income, you cannot contribute to a Roth IRA for 2015. So despite your ability, your desire to make that contribution, if you're over this limit, you cannot contribute directly to a Roth IRA. However, there's still a way to get funds into a Roth IRA even if you are over that threshold. The IRS allows anyone, regardless of your income level, to contribute to either a traditional or SEP IRA. Again, a SEP IRA is for individuals who own their own business or are sole proprietors. You can always make a contribution to a traditional or a SEP IRA. Once you have the money in that account, there is no limitation on individuals who wish to convert those monies into a Roth IRA account. So if I were not able to make a contribution into my Roth IRA directly because of my income, I could instead make that contribution to a traditional IRA, possibly get the deduction for it, and then turn around and convert it right into a Roth IRA account because there is no income limitation on doing a conversion. That was something that was changed back in 2010. Prior to that time, there was. So this was not available until after 2010. Everybody can convert. So you can put money into a traditional, put money into a SEP, and then turn around the next day and do a conversion into that Roth IRA account. Now, again, when you do a conversion, conversions basically are paying the taxes. So if you have money in a traditional IRA already, and you said this Roth IRA sounds great, I'd like to have this money grow tax-free for me rather than tax-deferred, you can move money from the traditional to the Roth, and you will get a 1099 for the amount that you convert in that given tax year. So if I have $30,000 in my traditional IRA, I'd prefer that money to be in a Roth. I convert that $30,000 here in 2015. Then that $30,000 going into all of it moves into the Roth, and I get a 1099 at the end of the year for $30,000. And I end up paying the taxes that would be due by just simply including that $30,000 in my ordinary income for the year. Now, conversions can be partial. It does not have to be full, and quite often we will see clients who meet with their tax advisors towards the end of the year to try to come up with a game plan. How much can I convert this year, and how much taxes am I going to end up paying for doing that conversion? and they may only convert a portion of their account. It can be all, it can be partial. You can even undo the conversion if it ends up being a bad idea as well. But why do people convert? One, if you're in a low tax situation this year, so you get towards the end of 2015 and realize you're going to be in a lower tax bracket. By doing a conversion, you may end up paying lower taxes based on the fact of what brackets you were in. Or if you have a lot of deductions or write-offs already, those deductions and write-offs or losses will offset the income from the conversion to the Roth IRA account. And again, the most important thing is the benefits of the Roth IRA begin immediately. So if you have a $30,000 in a traditional IRA, you convert it to a Roth, and then in a few days later you start receiving dividends into that Roth or income into that Roth from an investment that is all starting to accrue immediately as tax-free to you, to your Roth IRA, rather than tax-deferred. Now there are some special distribution rules to remember too with a Roth IRA account. The IRS considers kind of Roth IRAs almost as a first-in, kind of first-out way rules of accounting. And that when you take money out of a Roth IRA, the IRS deems that you always are distributing the amount of your contributions are coming out first. So when you withdraw from a Roth IRA, you will always withdraw all of your contributions first before you then get into the amounts that you have converted from a traditional IRA or a SEP into that Roth. And then lastly, once you've exhausted all of that, you now then begin to start touching your earnings. Now what's important is that the IRS will always allow you to take out the amount you contributed tax and penalty free. So if your distributions from your Roth IRA never exceed what you put in out of pocket, you will not pay any taxes in pulling that money simply back out. So for a lot of individuals, we'll start an IRA, a Roth IRA account, can make a contribution in January of a given year for that tax year. If they need that money at some point, they can always pull any amount up to what they contributed without tax, without penalty. Once they begin touching conversions or earnings, you might have penalties from them standpoint on. And just to illustrate this, take an individual who contributed $4,000 to his Roth IRA in 2011, contributes another $11,000 over 2012 and 2013. So he's got a total of $15,000 in contributions to his Roth IRA since 2011, but the current balance of the account is $20,000. So he's got $15,000 of earnings. I'm sorry, $15,000 of contributions, $5,000 of earnings within the particular Roth IRA account. Now he's under 59.5, and in 2015 he takes a distribution of $4,000 to go buy a new four-wheeler, some kind of toy. He just wants to pull the money out personally. Maybe he goes on a vacation. Question is that distribution taxable to him? And the answer, if you remember from the last slide, would be no, because the $4,000 Ben pulled out of his Roth does not exceed the $15,000 in total contributions he has made over the years. So Ben would not pay any taxes at all in pulling that money out at age 43. Now, if he decided instead to pull out the full $20,000, what would happen? Well, the first $15,000 would come out to him tax and penalty free because it's the amount he contributed. The remaining $5,000 of earnings would be subject to a 10% penalty because he's under the age of 59.5, and that money would also likely be included in his income as well. If he was over 60 when the distribution occurred, that $5,000 would simply be subject to income tax because it has not been the 5-year period to have a Roth IRA account. So this point of this example, just to remember, you can always pull out the amount of your contributions from a Roth IRA account without tax and without penalty. Now, one question I have gotten from time to time over the years and talking to people about Roth IRAs is the kind of the aspect or the fear that at some point the government is going to take away Roth IRA accounts. So they're going to simply say you can't do Roth IRAs, can't make these contributions anymore to these types of an account. And I kind of heard the individuals say this. I don't think that's the case, and this is kind of my personal reason and thought on why Roth IRAs would very likely be here to stay. Now, there may be some talk and there may be some consideration down the line. They might cap how much your Roth IRA can have in it. But as far as the ability to contribute, I don't think they're going to simply just take away Roth IRAs. And for this, what this purpose of this slide is to illustrate that example. If you have 100 individuals make a $5,000 contribution to a traditional IRA in a given year, that's $500,000 worth of tax deductions. Money the government, individuals are going to write off on their tax return and get a deduction for. Now, if the taxpayer's average rate, if all 100 individuals, if their average tax rate was about 20%, this would result in $100,000 less of tax revenue that the government would actually receive. Because the $500,000 deductions, that's $500,000 less income that the IRS, the individuals have to pay taxes on, $100,000 less in tax revenue. Now, they're going to get some tax revenue down the line, maybe 30, 40 years from now when these 100 individuals reach retirement age. But as of right now, the government is foregoing $100,000 in revenue. Now, again, these are only 100 individuals that we're talking about. If you multiply that with the actual number of people that make a contribution to their traditional IRA, that's quite a large figure. Now, the effect of the Roth contributions, if those same 100 individuals were willing and able to make that contribution instead to a Roth IRA account, there is no deduction. The government will wind up with $100,000 more in tax revenues this year as opposed to waiting into the future. This reason is why I don't see Roth IRAs being eliminated anytime soon. I think the government would prefer, that people in power generally prefer to get more revenue now rather than deferring that benefit until 30 or 40 years from now. The question just came up in the screen. Again, I encourage anyone listening live to type your questions into the chat box. Question came up and said, I earned $3,200 this year from something other than Social Security. Can I make a contribution to a Roth IRA? The answer is yes. If that $3,200 is earned income, you would be able to contribute probably up to $3,200 into a Roth IRA. You can never contribute more into an IRA account than you had in earned income. So in order to make a full contribution to an IRA account or a Roth IRA, you have to have the full amount of earned income. So in this case, since your earned income, if I'm reading this correctly, is $3,200, you cannot contribute more than $3,200 into that Roth this year. So the previous 20 minutes or so, really we're just, again, focusing on Roth IRAs. I want to kind of get into a little bit more different part of the presentation today. But again, if you have questions, please type them into the box. Transfers and rollovers. Just want to go over the terminology for moving money around. If you have an account with a Schwab, with a Fidelity, you have a Roth IRA at that firm, and you said, well, I'd like to invest in a piece of real estate or maybe make a private mortgage loan with my Roth IRA. How do I get the money from that account to an Advanta account without paying taxes? Simple answer is you would do a trustee-to-trustee transfer. A transfer is moving funds directly from one IRA over to another without you handling the money and therefore not having a tax consequence for doing so. If you have money in a 401k or an old 403b plan and you'd like to move that into a Roth IRA, you can also do so. This would be considered a direct rollover, but since it is coming from a pre-tax 401k into the Roth account, this would basically be doing a conversion. So you're going to get a 1099 for the full amount that you roll over from the employer's plan into the Roth IRA. The important thing to consider, again, is that doing transfers between Roth IRAs, doing direct rollovers, and also, most importantly, especially as we talk about tax-free income, the earnings within a Roth IRA are unlimited. The only thing you are limited to with a Roth IRA is how much you can put in out of your pocket each year, either $5,500 or $6,500 if you're over the age of 50. And again, there's some restrictions on income as well. But there is no limitation on how much money you can earn within that given account. A question came up, is the max income amounts based on income before or after all my tax deductions? I believe it's before some of them, but maybe there are some other deductions you can get up front. But that would be a great question to ask a CPA or a tax advisor. Maybe contact me afterwards, and I'll try to look a little bit more into that. It's not after all of your deduction. It is the modified adjusted gross income figure that you have. Now, as far as investing within a Roth IRA account, there's only two types of investments you cannot make. Per IRS rules, you cannot invest in collectibles, and you cannot invest in life insurance. Those are the only two types of investments the IRS restricts you from making with a Roth IRA, or for that matter, any retirement account. Now, collectibles would include your antiques, alcohol, artwork, etc. The other restriction the IRS places on retirement investing, again with the Roth IRA or others, is who your IRA can transact with. There are certain individuals who are considered disqualified from transacting with your IRA account. So if you have an IRA, the disqualified persons include yourself as the IRA owner, your spouse, your parents and grandparents, your kids and grandkids, also any spouses of lineal descendants as well. They would also then consider a disqualified person or entity to be any business or entity that is owned or controlled by one of those individuals as well. So in short, if I had money in my Roth IRA account, I cannot lend it to my son in order on a mortgage loan and have him pay me back. He is a disqualified person. I cannot use that Roth IRA money to buy a house that I intend to live in, because as an IRA owner, I am not allowed to get any current personal benefit from my Roth IRA account. If my Roth IRA bought a piece of real estate from my father, buys a piece of property for myself, again, those all will be prohibited transactions. And again, you do not get around those rules by simply lending money to, say, your son's business or buying a piece of property from your father's LLC, etc., because those businesses and entities are also owned or controlled by a disqualified person. So if you're looking to transact with your IRA into something alternative investment with a self-directed IRA, you need to be careful and make sure the person on the other side of the transaction is not disqualified. Just some other general rules. Again, you cannot self-deal, so you cannot sell between your IRA and yourself or a disqualified person. You cannot get any current benefit from the IRA account. You cannot borrow from an IRA or a Roth IRA account. So you personally cannot borrow from the plan, and you can't pledge that IRA as collateral for any purpose. You can borrow from a 401k. That's one thing people do get confused from time to time. If you're involved in an employer's plan at work, you may have the ability to borrow from that plan a certain amount and make payments back to the plan. That rule for 401ks does not extend to IRA accounts. And at least under Florida law, where I'm based out of, I have experience, your IRA is exempt from personal creditors, but not from creditors from the IRA itself. So if your Roth IRA buys a piece of real estate and is holding a piece of real estate and receiving rental income every month into that account, if you are personally sued for an action arising from your personal life, your IRA, your Roth IRA under Florida law would be protected from any of your personal creditors. But if somebody slipped and fell on the property owned within your Roth IRA, that person might be able to, or could very possibly be able to, sue your Roth IRA as the owner of the property itself. That's one thing people do get misconstrued from time to time, is the liability protection of IRAs have, because they do have liability protection for any instances that happen with you personally, but not necessarily from assets that are held within the IRA itself. I'm going to switch gears now and go into some case studies, really explain a little bit more how the process works and what our role is at Advanta is as the record keeper and administrator of an account. Also illustrate some things people have done with their Roth IRAs over the years and how that money is generating tax-free income back into their accounts. In the first situation, we have John and Jane, who each have money in a Roth IRA account. They're looking to purchase property, and they're looking and find a house that is a little bit more than either one of them has within their retirement account. So John and Jane don't have enough to buy it outright in one of their IRA accounts, but they figure if they can partner up their Roth IRAs together, they would be able to make this purchase. They find a sale for $60,000 and need an additional $10,000 of work to get it ready to rent. So they can actually put combine their $40,000 in each of their Roth IRAs in a partnership arrangement, and have then the property cash flow at the end of the month, money back in to their accounts to be split. So John and Jane would each open up an account at Advanta, transfer funds from their current administrator, and fund their Advanta account. So we would actually fill out a paper. We would send to their current administrator, request that $40,000 over from their current administrator over into the IRA with us. And again, John and Jane, it is their responsibility to find the property. We are not going to provide them with any investments, not going to suggest any investments to them. They're going to find this property on their own and make the offer to purchase. Now, we will then work with them within the process to make sure their IRAs are properly listed as the owners of that particular piece of real estate. I'll show you what that wording is in just a moment. John and Jane are going to let us know what property they're purchasing by submitting a purchase authorization form. And they also are going to let us know who is handling the closing, whether it's an attorney, whether it's a title company, and then we will work with that individual or that entity to make sure that all the closing documents get titled in the name of their Roth IRA. It's very important to preserve the tax status of the IRA, that the assets that are purchased get titled in the name of the IRA itself. That makes clear demonstration to the IRS that the assets were titled correctly, and these are indeed investments within the IRA account. Now, before we will sign any documents, before we send any money out of the accounts to make the purchase, we will also have John and Jane review and approve all of the paperwork for us first. We will not send any money without their express approval on all of the documents. Once they have approved, though, we will sign, wire the funds, and again, this screen shows the wording that would be on the deed in this particular situation. Advanta IRA for benefit of John's IRA and his account number as to a 50% undivided interest, and also to Jane's IRA as to a 50% undivided interest as well. The percentage then is based on the amount that comes from each IRA, no more and no less. So if John or Jane had decided to fund more of the purchase from their particular IRA account, then they would hold a larger percentage of that particular property. The percentage is again going to be based on how much is coming from each different IRA account. Now, once the property has been purchased, any expenses, if there's any repairs to be made initially, if there's any ongoing maintenance, the taxes and insurance associated with the property must be paid directly from the IRA accounts. That's the job we do at Advanta after the initial purchase and making sure things get titled correctly, as we will then also pay all the bills related to that asset and also receive and deposit any of the income. So we'll process the checks out to pay expenses. When John and Jane get this property rented, we will receive and deposit the rents into their accounts as well. Now, as far as some exit strategies, if they were just to continue holding this property long term, say they have about $80,000 or $70,000 total invested in this property, they're getting $700 a month in return. That's a little over 12% or so tax-free back into their Roth IRA account. Again, all of the net cash flow at the end of the day coming back into the Roth is going to be tax-free. Whatever they're earning, as long as they're going to wait till they're 59 and a half and they've had an account for at least 5 years, that is all going to be completely tax-free to them. Another option, maybe their intent initially was to rent the property, but after fixing the property up, they got an offer from someone that wanted to actually just buy it. Just come out flat underneath and say, hey, we'll just buy the property. We're not interested in renting, and we'll buy it for $100,000. Well, any of the sales proceeds from that sale would also come back into their Roth IRAs completely tax-free. Now, they've only held the property for maybe a month, 2 months. That doesn't matter. All of the gains from that sale simply come back in to their Roth IRA accounts. The third strategy I've seen a couple clients do, actually sell the property and hold back the mortgage. A little more advanced strategy, doing some seller financing with their Roth IRAs, getting, again, the interest on that loan coming back in tax-free. Before I go to the next slide, I did have a question pop up that I want to get to. Question is, if I currently have an investment property I'm rehabbing, can I borrow money from my Roth now for the repairs at an interest rate to earn money for the Roth? The original funds of purchase, 90% was a hard money loan and 10% was personal. Property was purchased in a land trust, and I am the beneficiary of the land trust. The son is trustee. Unfortunately, because you personally own this property, even if it's through a land trust, within which you are the beneficial owner, your Roth IRA cannot lend money to you or to that trust. Now, going forward, possibly on the next property you purchase, it might be possible for your IRA to partner up with yourself personally to actually make an investment and then share in the income and expenses going forward from there. But since you already have closed on this property, already own this property personally, you're prohibited from borrowing the money from your Roth. Your Roth, again, could partner up in the future with you. Your Roth could lend money to other parties, and we'll go through an example of that here in just a moment. Question is, if you have property insurance on a rental property, is it paid by the Roth? Yes. If your Roth IRA owns a piece of real estate, your Roth IRA must pay for all expenses, including property insurance, taxes, maintenance, etc. And then again, that is the role we serve here at Advanta IRA to make sure those bills get paid. Next case study is on wholesaling. We actually have had a client do this a few times within their Roth IRA, basically using their Roth IRA. They started out smaller, didn't have a lot of contributions into the account, maybe not as much money to work with going forward. They use their Roth IRA to wholesale the particular piece of real estate. So within this particular deal, Olivia's IRA, her Roth IRA account, is entitled to the contract to buy a house for $50,000 from John, some third party. Her Roth IRA gives the $1,000 escrow deposit. So her Roth IRA, Advanta IRA, for benefit of Olivia's Roth IRA, is the buyer. That IRA makes a $1,000 deposit, and Olivia also makes sure that that contract is assignable, so that when she finds a new buyer, someone for John's house who's willing to pay $60,000. Remember, she has a contract for $50,000. She finds someone else willing to pay $60,000. That new buyer will simply pay her IRA or her Roth IRA a $10,000 assignment fee to assign that contract and sell that contract to that new buyer. So her Roth IRA was able to turn $1,000 into $10,000. Now, wholesaling is a little bit different scenario. Obviously, that's something that maybe requires a little bit more work, knowing the right people. But again, I have seen a few people do this successfully within their IRA account. They're starting with a little bit and kind of start to get their Roth IRA going a little bit faster by doing some of these wholesaling deals. Now, a common form of lending that we see in an IRA a lot of times can be in the form of a joint venture. You can certainly lend people money within your IRA accounts like a traditional mortgage loan and just charge them an interest rate. But in this particular case, we have Laura, who had money in her Roth IRA, thinking that she could actually do a hard money loan herself as a private lender to a borrower, somebody who is rehabbing a property and is looking for private money with which to get that property rehabbed. She meets Ray. He's looking for a partner, and she does her due diligence on him. Again, it's important in this case that Laura is looking into Ray and doing her background checks and also on the property as well. Again, in Advanta IRA, we are not going to look at the property. We're not going to look at your borrower and make sure that you're making a good investment. That is solely the responsibility of you as the client. So Laura offers to lend $50,000 to Ray in order to make this particular deal. So they could structure this in a couple different ways. If they're looking at joint venturing, Laura's IRA and Ray could both be on the deed and both be on title to the property and share income and expenses accordingly. Perhaps they could form an LLC or a partnership, and we'll have an example of that in just a moment. But in this case, Laura decides it's simpler, and maybe she feels more comfortable with doing it as a mortgage loan instead. So Ray actually gets a $50,000 loan from Laura's Roth IRA account, and he does give her a mortgage on the properties to secure that loan, so she has some collateral for her loan. She decides to have no interest and no payments for Ray. Basically, the payoff is going to be whatever he sells the property for, over $100,000, whatever profits he makes, her Roth IRA is going to get half of that. So they're basically splitting the deal 50-50, but she's just structuring it instead as a mortgage loan to Ray. Now, some people would prefer instead in this circumstance to have their IRA on title and be on the title to the property, or be involved in an LLC that is on title. In this case, for whatever reason, our client decided to simply structure this as a mortgage loan instead. So Ray is on the deed. Laura's Roth IRA is simply a lender, and Ray signs a note and mortgage, and when the property sells, ultimately she'll get paid that way. Laura's attorney would prepare the note and mortgage showing, again, Advanta IRA for benefit of Laura's Roth IRA as the lender, and she is going to review and approve all documents for us first before ultimately we fund that note and send the money to the title company. Now, if the property sells for $140,000, let's say it nets $30,000 in profit, the $130,000 was the net. Ray would repay the principal of $50,000 and half of the profits back to her IRA account. Again, that gain is all tax-free to her Roth IRA. So obviously they did well on this property, made a lot of money. Whatever gains she gets, again, completely tax-free to the IRA account. So whenever you're doing lending within an IRA account, again, whether it's an IRA or whether it's a Roth IRA, as the private lender, you get to establish all of the note terms. How much you're willing to lend, how much is being borrowed, the interest rate, the length of term. Is it amortized or is it an interest-only loan? Is there any equity participation terms? And again, all these terms that go into this, we've seen a number of mortgage loans over the course of our time here at Advanta, and all of the terms fluctuate and are different depending on the individuals. And that's your right as a client, as the lender, to decide what terms you want in the particular loans you do through your Roth IRA account. Now, the last case study we're going to talk about today and wrap up the webinar is in dealing with an LLC. And so in the last example, we had Laura and Ray looking to partner up on a deal, and they decided to structure it instead as just a mortgage loan. In this case, we have three individuals, Larry, Mary, and Gary, all looking to use their Roth IRAs together to invest in joint venture into real estate. They decide that it would be easier to form an LLC, whereby each of their IRA accounts will own 1/3 of Real Estate Partners LLC. So they're still going to be buying rental properties, but they're just going to do it through this other entity, which will give them a little bit more control. Now, when you're investing in an LLC or LLP, we want to see at Advanta, we want to see the operating agreement that shows the three IRAs as the members. That's where the ownership comes in with an LLC or LLP. If you're buying property, the ownership is reflected in a HUD statement, in the deed to the property. And if you're doing a note, that's going to be in the note or the mortgage itself. It's kind of just different paperwork depending on how you structure the investment. But in this case, again, with an LLC or a partnership, we want to see the partnership or the operating agreement for that particular entity. And within that agreement, the three IRAs will be listed as the members and the owners in that particular LLC. So Advanta IRA for benefit of Larry's Roth, Mary's Roth, and Gary's Roth are all three listed as the 1/3 owners within the operating agreement. The operating agreement will then be signed by us on behalf of each IRA account, and Larry is going to sign as the manager. But again, before we will sign the documents, we're going to make sure we have the approval of the clients as well. By structuring the agreement and the transaction within an LLC, it allows Larry to get a checking account for the LLC and have the Advanta simply send all of the cash into that LLC account. And then Larry is going to manage the funds from there, purchase the investments, write checks, deposit income, etc. So again, Larry, Mary, and Gary are each going to open up and fund the accounts with us. And instead of instructing us to buy 1/3 ownership interest in 123 Main Street, they're simply going to instruct us instead, please make an investment of 1/3 interest in Real Estate Partners LLC. So we will want to see the operating agreement. We encourage you to use an attorney. You're not required to, but we do encourage it. And again, the three of them are going to approve the documents by signing off that they've approved the operating agreement. We will sign the operating agreement. And then once Larry has opened the bank account, we can send the $50,000 from each of their accounts into that bank account. Now going forward, Larry then has the cash, again, to acquire the assets and make any purchases. As far as our role at Advanta, any future dividends, if they use that money to buy property and are starting to return a lot of cash into their LLC bank account, and they would like that money to go back in the Roth, we would receive and deposit that not as rental income, but simply as dividends from the LLC. So again, Real Estate Partners, once we have funded that entity is open, it has $150,000 in cash. Real Estate Partners LLC would be on the contract. It would be on that same name, would be on all the closing documents. And at that time, Larry is the one actually signing as the manager in executing all the closing documents in the name of the LLC. And again, the deed would be in the name of the LLC as well. Now that the LLC owns the property, Larry would help get the property rented. And then the income is simply going to come back into the LLC bank account. So it allows Larry, Mary, and Gary to take the check writing control and take control of all of their cash and move it to the LLC where maybe they have better control over the funds, be able maybe to do multiple investments as well and make things easier as well. Any distributions, again, to go back to the IRA owners, would have to come first back to the IRA. Now, at the end of the day, if they, Larry, Mary, and Gary sell the real estate within the LLC, and they go to dissolve the LLC, they're going to return 1/3 of the total proceeds back to each of their IRA accounts. I did have a couple questions come up again here, and I encourage anyone else who has any to please get to them. First question, what if you don't have enough money in your Roth to pay for insurance and repairs? Do you have to pay at least the insurance and whatever is remaining in your Roth for the repairs? Whenever you are doing a transaction with your IRA account where it owns a percentage in a property, whether you're partnering up with yourself or partnering up with some other parties, your IRA is expected to pay for that percentage of each different repair. So if you don't have enough in the account to do it, then you'd have to look at either possibly borrowing the money, bringing in another partner. But usually the recommendation is when you're analyzing the loan up front, or analyzing the transaction up front, is to see what you have in your Roth IRA and do your best to estimate what your expenses might be before you start getting any income in, because your Roth IRA will be expected to pay for its percentage of repairs. Next question, if you're lending money from a Roth IRA account, is there a maximum interest rate that you can charge? Now, the only guidance we would give you on interest rates, if your Roth IRA is lending to some third parties, you probably can't charge more than what would be considered usury. Now, in Florida, usury is a stated interest rate of above 18%. So kind of anything probably between 3 or 4% up to 18 is something that we would process. In the example we showed earlier, Laura got more than 18%, but it's because she was engaged in more of a joint venturing deal. I think that's much different than doing a stated interest loan of greater than 18%, but that we will not process a loan if the stated interest rate is over 18%. Next question, my IRA puts up 20% of the purchase money and hard money puts up 80% of the purchase. How you're being compensated for sweat equity, so we agreed to the Roth getting 40% profits and the hard money lender getting 60%. Is that acceptable? Couple issues involved in this question. One, if your IRA is putting up 20% and you're looking to get a loan for the other 80%, you do have to make sure that the loan is a non-recourse loan from the borrower, from the hard money lender, to the IRA account. You are prohibited under the rules from personally guaranteeing that loan. So that's kind of step one in this particular question, is to make sure the hard money lender is simply lending money to the IRA and not to you personally. Second, within the rules for the IRS, if you are engaging and you're buying real estate within an IRA account, you are not supposed to contribute any sweat equity or work to that particular property. Your IRA is expected to pay third parties to get that actual work done. If you were to contribute your own labor for the benefit of your IRA account, the IRS would likely again consider that to be prohibited, because you're prohibited from making a contribution of labor to your IRA. Contributions can only be made in cash. Now, kind of taking a couple of these issues aside from what was in the question, if you had your IRA put up 20% and some other party was willing to put up the other 80%, and that other party was going to do a couple things or do some work, I can see you adjusting the profit percentages a little bit, but it should not be based on any work that you personally are doing. So I've seen a situation where a Roth IRA or an IRA has perhaps put in $100,000 to a deal. The other party didn't put in anything, but then they split profits 50-50 because the other party was not disqualified. They were a third party, and that third party was doing the physical work, doing the physical labor. I can see that type of scenario. It's kind of what we saw in the joint venturing loan between Laura and Ray. She was putting up a great deal of the cash. He was doing the work, and they were then splitting the profits accordingly. I can see that being done as well. But as far as your own sweat equity, that is not permitted. Next question. If I convert one of my houses later this year to the Roth, will Advanta move the rent accrued this year before the actual conversion to the Roth? The answer is no, because the income for the conversion, it's as of when the conversion is done. So if you've received rent between January and April of this year, and then you convert to a Roth IRA in May, the January to April portion will all be still income to that traditional IRA. That would be included in the actual cash. If you did a full conversion, we would convert the value of the house and of the cash as well. So you'd be taxed on all of it and moving owners. Only after you do the conversion of the property to going forward, the rental income from May on, that would then all be accruing tax-free to the Roth IRA account. That concludes today's webinar. If anyone has any other questions, please get them in quickly, or else, again, here's my contact information on the last slide. You can email me or call me at the number here. I'd be happy to answer any questions that maybe something I touched on today that was a little confusing or you weren't quite sure on, or maybe something I didn't get to that you really had a question and would like some more answers on. I would encourage you to visit our website at advantaira.com for other upcoming events and seminars, whether it's another webinar that you can participate in your computer, or maybe a live event at one of our offices as well. And I think at our website you'll find a great deal of information as well on self-direction. So at this time, I'd like to conclude the webinar. Again, thank everybody for participating, and I look forward to talking with you.